This monetary policy statement is issued in terms of Section 46 of the Reserve Bank Act, Chapter 22:15. It discusses the measures and policies being pursued by the bank. The measures and policies are aimed at accomplishing the bank's key strategic focus area of ensuring exchange rate and price stability, the smooth functioning of the interbank foreign exchange market, and providing support to economic activity without endangering the important objective of reducing and stabilizing inflation in the short to medium term. This statement comes at a time when the main thrust of the bank is to stabilize the economy by bringing down inflation and stabilizing it, more so after the initial burst of inflation that followed from the liberalization of the exchange rate and fiscal consolidation in 2019. Stabilizing the negative shocks, which are called cost of adjustment, that emanated from the economic reforms that the country went through in 2019 in its quest to right-size or rebalance the economy, is necessary for rebuilding confidence within the Zimbabwean citizenry and for creating a conducive economic environment for sustainable growth. Specific measures that the bank is pursuing to stabilize the economy include the following. 1. Implementing the monetary targeting framework geared at addressing inflation and exchange rate volatility. 2. Enhancing transparency on the interbank market in order to provide efficiency in the foreign exchange market. 3. Injecting additional cash to address cash shortages in the economy. And 3. Promoting confidence in the monetary policy through effective communication and forward guidance in the public expectations, which are the epicenter of inflationary development in Zimbabwe. Consistent with the bank's policy thrusts of ensuring exchange rate and price stability, the economy managed to achieve a sustained decline in month-on-month inflation since October 2019 and relative stability in the exchange rate. This trend is consistent with a positive macroeconomic outlook for the country, which is to grow by around 3% in 2020, and month-on-month inflation we expect to be below 5% by year end. The bank is committed to ensuring that the above fundamentals are achieved through the bank's use of monetary targeting framework to achieve price stability, whilst at the same time addressing the emerging challenges of depressed aggregate demand that we are noticing within the economy. Focusing on confidence building through effective communication by the bank has also become extremely important in view of the fact that a key factor that causes inflation in Zimbabwe is people's expectations of future inflation. These non-monetary factors are grounded on the public's past negative experiences with inflation. In addition, the bank is committed to improving the depth and efficiency of the interbank market with a view to enhance its efficacy and thus ensuring a credible, predictable, and sustainable exchange rate determination framework. This will produce stability and enhance confidence in the foreign currency market. The current measures being pursued by the bank are a combination of policies and decisions made by the bank's monetary policy committee and which were communicated to the public through the press releases over the past 4 months. The bank is pleased with the concerted effort by the MPC, which has assisted to improve policy transparency, predictability, and certainty through its focus on the core mandate of the bank, which is basically to manage inflation and to stabilize the exchange rate as of now. So this monetary policy statement is organized in such a manner that we shall present you the policy measures that we are putting in place, and of course provide annexure of all the developments regionally and internationally, so that this which buttresses the monetary policy statement. The policies that we are going to put in place, which we discussed last time in October 9, 2019, whereby the bank made a number of critical policy initiatives, which principally include the liquidity management framework, the de-dollarization framework, reviewing of minimum capital requirements of banks, and the setting of bank policy rates. The bank also advised on gradually injecting additional notes and coins into the economy to lessen the inconveniences caused by the shortage of foreign currency, of physical cash to the transacting public. In addition, the bank introduced credit enhancing measures to incentivize and encourage banks to lend long-term. The policies that the bank shall be pursuing this year in the conduct of monetary policy are as follows. Number one, liquidity management. The level of liquidity or money supply in the economy is measured by total bank deposits stood at $34.5 billion as at 31st December 2019, composed of $22 billion in lower currency, which is 64%, and $12.5 billion or $785 million or 36% in foreign currency. It is this liquidity or stock of money that is the key focus area that the bank is mandated to manage to ensure that it does not cause inflation and or bring volatility in the exchange rate. So our work is made much more simple. 34.5 billion, how to manage it in the economy. Focusing on liquidity management becomes even more critical, especially in the context under which around 50% of this 34.5 billion is concentrated on only 200 entities, whilst the majority of the Zimbabwean population is struggling to make ends meet in an economy with a huge output gap. The bank is therefore committed to the full implementation of the monetary targeting framework to regulate the amount of money supply in the economy and align it with its desired inflation and exchange rate levels. This framework will be operationalized through the use of existing open market operations tools that include treasury bills, savings bonds, corporate bonds, statutory reserve requirements, and the specific liquidity management instruments to deal with the uneven distribution of deposits in the economy. As of 31st of December 2019, the outstanding savings bonds were $1.9 billion, down from $2.2 billion already over the same period in 2018, while the statutory reserves balances amounted to $918 million as of 31st of December 2019, representing 129% increase from the $401.5 million 28 position. 2, enhancing the Reuters Forex Interbank Market Tracker System. The main aim of the Reuters Foreign Exchange Market Tracker System that the bank is putting in place is to improve the operation and efficiency of the foreign exchange market through a more transparent foreign exchange trading platform. As advised by the bank, the electronic deal tracker system under the Reuters platform went live on a trial basis on 2 December 2019. Accordingly, the next step is for banks to become market makers in the user test environment to make sure that the new trading platform can handle the tasks in the live environment. The bank shall set aside appropriate foreign exchange resources to intervene and stabilize the market as may be required once the enhanced interbank foreign exchange market becomes operational. The bank is also undertaking a further refinement of the activities of Bureau of Exchange with an objective of strengthening their operations. 3, credit enhancement measures. The MPC operationalize credit enhancement measures through the creation of a medium-term bank accommodation window, which I'll just call MBA for ease of reference, to support banks with productive sector funding requirements. A total of $800 million had been disbursed under the MBA window as at 31 December 2019. This amount is within the MPC's target of $1 billion agreed in 2019. At this meeting on Friday, the 14th, the MPC agreed to review the limit under the MBA window to 1.5 billion in order to cater for the winter agricultural preparations. In addition, the bank shall ensure the appropriate measures are put in place to limit its impact on inflation and exchange rate, in other words, of this MBA. As emphasized by the MPC, access to the MBA window depends on the quantum of medium-term and long-term productive lending undertaken by banks, institutions to the productive sectors of the economy, since we are in a program to ensure that we increase production in this economy. In this regard, banking institutions are encouraged to reorient their lending portfolios to the productive sectors of the economy. Banking institutions are further encouraged to partner with the private sector players across the value chains as part of the strategy to increase productivity and export earnings in the national economy. Financial institutions are also encouraged and expected to increase their support to the micro, small and medium scale enterprises in order to deepen financial inclusion. Support to the MSME sector is the potential to promote value addition to this key sector of the economy through diversification, export earnings, and import substitution, which are all critical for increased output that we want in this country. Implementation of the collateral registry by June 2020 will enable the MSMEs to leverage on their movable assets to access funding from formal financial institutions. In this regard, the banking institutions, microfinance institutions are required to submit to the bank detailed strategies to support the productive sector during the period 2020-2021. The strategy document should be submitted to the bank by the 30th of June 2020. Bank policy rates, fourth one. Following MPC deliberations, the bank reduced its policy rate on overnight accommodation from 70 to 35%, as you all know, effective 20th of November 2019, in order to promote confidence in the economy and minimize non-performing loans. At this meeting on the 14th, which was a Valentine's Day, I think the MPC was thinking in such a manner that they will provide more confidence in the economy. At this meeting on the 14th of February 2020, last week, on Friday, the MPC resolved to maintain the policy rate at 35% per annum. The interest on the MBA, the medium-term bank accommodation window, was also maintained at the level that reflects the yield on the open market for treasury bills, which is currently between 15 and 18%. The bank, through the MPC, will continue to proactively guide the market on the expected path of interest rates as part of its efforts to build on policy transparency and confidence. 5, availability of cash for transactional purposes. Following the MPC decisions in October 2019 to increase the quantity of bank notes and coins in circulation to try and reduce inconvenience being faced by the public in accessing their cash at banks, the bank has imported additional bank notes and coins to ameliorate this situation. As an additional amount of 150, as you are aware, was disbursed in the last quarter of 2019 to give a total of $1.1 billion worth of notes and coins in circulation as at 31 December 2019. The 1.1 billion represents 3.2% of total banking deposits of 34.5 billion as at 31st December 2019. And as per normal banking practice, the notes and coins sold are sold to bilateral banks for distribution to clients in exchange of their electronic balances here at the bank. So this is done to make sure that there is no inflation that is created by putting new money into the economy. Accordingly, the cash injections to date have not and will not increase money supply and thus managing inflationary pressures. The bank will continue to gradually increase the notes and coins to the desired optimal level of around 10% of deposits, which was agreed by the MPC and which is also in line with international best practice. In fact, 10% is lower than other countries in the region, but that's what we agreed for now as a bank. Moreover, the bank will also gradually introduce notes in larger denominations to improve efficiency and convenience to the public. 6, review of minimum capital requirements. As you are aware, a strong capital base is pivotal to banking institutions' ability to contribute meaningful to economic growth and development through effective financial intermediation. More importantly, capital enhances the banking institution's capital to cushion against losses. And ongoing reviews of the minimum capital levels ensure banking institutions continue to play a meaningful role and contribute to the economic development or turnaround strategies of the country. Pursuant to the bank's MPC releases on 22 January 2020, the minimum capital requirements for the banking sector were advised and were reviewed upwards in Zim dollars equivalent to the following amounts. Tier 1, which are large banks, commercial banks, and foreign banks, US equivalent of 30 million. Zim dollar equivalent of 20 million for Tier 2, commercial banks, merchant banks, building societies, development banks, finance and discount houses. In Tier 3, which is the deposit-taking microfinance institutions, remained 5 million equivalent to our Zim dollars. And then credit-only microfinance institutions, $25,000. And you do believe that these minimum capital requirements are necessary and that all banking institutions shall advise the bank by June 2020 of their plans and the area which they want to be in. In other words, their strategies for compliance with capital thresholds. 7, de-dollarization framework. Following the gazetting of the statutory instruments 33 and 142 of 2019, that provided the de-dollarization framework for the economy to trade exclusively in local currency, which in this country is called monocurrency. The bank is encouraged by the positive de-dollarization process that has been taking place in the economy. The bank believes that the macroeconomic signals that include fiscal and monetary discipline, prospects of positive economic growth, and lower inflation are improving to support a gradual de-dollarization process within a time frame of 5 years. This is in line with the other countries' experiences on de-dollarization. The foreign currency deposits as a proportion of money supply went down to 37% by 31 December 2019. These are the measurements. How do you measure de-dollarization, or how do you measure dollarization? You measure dollarization by looking at the foreign currency deposits as a proportion of money supply. In the case of Zimbabwe, it went down from 50% to 37% by 31 December 2019. Whilst foreign currency denominated loans in the banking sector stood at 22% of total banks' loans and advances as at 31st of December 2019. The use of the local currency for transacting purposes has also continued to go up, reaching a total amount of $459 billion from 189 million transactions for the full year of 2019. So if you look at the trend, it has been very positive that most of the transactions in this economy are being conducted on a local currency basis. These measurements of the proportion of the use of local currency in the economy show that the country is on a right trajectory to de-dollarization. The bank shall therefore continue to provide incentives to promote and defend the use of the local currency within the economy in order to support the de-dollarization process. 8. Use of free funds. The use of free funds in Zimbabwe has always been allowed since time immemorial. It has remained virtually unchanged. The unfettered or unrestrained use of free funds is in line with the regional and best practice, as free funds are outside the exchange control territory of the country. Free funds play a catalytic role in exerting confidence in the economy and in promoting economic development. They constitute, in the case of Zimbabwe, around 30% of Zimbabwe's total export earnings. So it's a big chunk. 30% of 4 billion is our free funds in this country. Free funds are made up of diaspora remittances, funds remitted into the country by international organizations, embassies, non-governmental organizations, NGOs, donations, and any other funds realized by individuals from offshore activities like consultants, legal practice, outside the country. These are all free funds. The bank would therefore like to reassure all holders of free funds that their funds in Zimbabwe are very safe and secure. The same is true for all other foreign currency accounts, in that the current export retentions are being maintained at their current levels. The bank has therefore no appetite at all to tamper with the legal status of the public or public's foreign currency accounts. We don't have any appetite whatsoever. Allowing the use of free funds within the national economy for the payment of customs duties on selected products, paying for emergency passports at the registrar's office, procurement of basic commodities such as food items and fuel under the direct fuel import scheme should not be misconstrued as going back to dollarization, but rather as a common good for the country to promote the inflows of free funds from the diaspora and necessary to buttress the confidence that is needed under the de-dollarization process. 9. Blocked funds or foreign currency legacy debt. Government through the bank is committed to orderly settlement of blocked funds, which are basically cash flows generated in Zimbabwe by foreign entities that could not be repatriated to foreign suppliers due to foreign exchange shortages, or commonly referred to as foreign exchange legacy liabilities or legacy debt. To date, exchange control has processed and validated blocked funds in an amount of $1.2 billion from 730 applications out of 1,080 requests received by the bank. Of those processed, of the 730 processed, 299 transactions with a value of 861 million were rejected for various reasons ranging from double dipping to lack of supporting documentation. The balance of 350 transactions with a value of 457 million are still being processed by Exchange Control and the Debt Management Office for finalization by the 29th of February 2020. The validated blocked funds, this 1.2 billion, excludes the legacy foreign exchange obligations of 361 million under the Reserve Bank of Zimbabwe Debt Assumption Act of 2015. So we already had blocked funds before. 10. Sustainable financing and climate-related risks. Globally, sustainable finance has become one of the emerging issues in the financial service sector, calling for integration of an environment, social, and governance standards into the process of providing financial services. Sustainability standards facilitate strong corporate performance of financial institutions and promote alignment of corporate strategies to national development priorities. To date, 8 banking institutions have embraced the sustainability standards and the satisfaction initiative, which is being driven by the European Organization for Sustainable Development under the Global Sustainable Framework Network. Meanwhile, the bank shall develop a sustainable finance framework within which will, inter alia, define the long-term objectives of the country's financial sector in relation to inclusive green financing and sustainable financing. Further, changes in global or regional climate patterns, with the global warming being the main aspect of climate change, is a current reality, with most parts of the world experiencing extreme weather conditions such as drought, flooding, and tropical cyclones. Zimbabwe has not been spared from the fragrance of the climate, as we are aware. Zimbabwe and our Kariba Dam at low changes and remains vulnerable. The economy's mainstay in agriculture is the economy's mainstay is agriculture. Hence, there is need to monitor and manage climate-related risks. The banking industry is not immune, given the potential wide-ranging consequences from climate change. The effects of climate change risks could impact banks' products that include loans, investments, derivatives, and everything. This underscores the need to manage climate-related risks like any other significant risks, and integrating material climate changes-related risks and opportunities into the financial institution business risk models and investment decisions. This is critical for banks, as most if your lending is to agriculture and you are prone to climate change, they might end up with a non-performing loan because of the climate. So you need also to improve your risk management profiles and assessment. So at the end of the day, if there is no water in that area where you're financing, you might want to support the farmer with a possibility to have a dam. So at the end of the day, your funding is also assured that you come back. Otherwise, it will be dead on arrival. Financial technology. Further to the advice in the 2019 mid-term mandatory policy statement, the bank is embarked on several initiatives to establish the fintech agenda. The bank is in the process of finalizing a regulatory sandbox framework. The framework will outline the qualification, application, and evaluation criteria for entities to be admitted into the sandbox. The sandbox provides an opportunity for innovators to connect to banks and other financial institution players. The operationalization of the framework will thus promote competition and effectiveness through innovation. I talk about innovation here. Technology and innovations have significantly altered the financial landscape and the way financial institutions offer services and products. In this regard, banking institutions are required to upgrade their ICT systems consistent with the development in the fourth industrial revolution. In addition, banking institutions should explore new technologies and business models to enable the institutions to compete in the digital age and come up with innovative banking strategies. Cybersecurity, the last one. The financial system increasingly become more reliant on information technology for delivery of products and services. As they do that, there is a heightened probability of cyber attacks. Given the highly dynamic cyber threat, banking institutions are required to, on an ongoing basis, to ensure that they have robust ICT platforms or systems and efficient or sufficient safeguards to deal with the cyber risks. In conclusion, the bank is positive about the outlook of the Zimbabwean economy, which is expected to grow by 3% in 2020 on account of increased international price of key minerals produced in Zimbabwe, such as gold, platinum, and palladium, coupled by the stable foreign exchange generation capacity of this economy. The bank is also confident that this year's agricultural output will be much better than initially anticipated due to improved rain received in January and February this year in most parts of the country. We are confident that the bank's policy mix, whose key ingredients are monetary discipline and an efficient foreign exchange market, will be effective in stabilizing consumer prices and the exchange rate. The stable exchange rate is then set to anchor the country's disinflationary program, through which monthly inflation is forecast to close the first quarter of the year by below 3%. In other words, we expect inflation by end of March to be below 5%. This trend would see the year-on-year inflation coming down to around 50% by December 2020. The confidence dividends from preserving the anchors of macroeconomic stability, notably inflation and exchange rate stability, will help to manage inflation expectations and foster a conducive environment for increased production and productivity within the national economy, thus underpinning the thrust of the 2020 national budget. I want to thank you for listening and welcome to the Reserve Bank. I'll take any questions that you might have. Thank you very much.